Good morning, everyone. Thank you for connecting to our webinar. I'm just going to give folks a couple more minutes to trickle in before we begin. Well, I think we can get started now. So welcome, everyone. Thank you for joining us today for our Small Business Taxes 101 webinar. My name is Kayla Terrazas. I'm a business advisor for the Illinois Hispanic Chamber of Commerce. And today we're also joined by our wonderful members and experts from Wipfli, Mandy Riles and Chuck Martin. But before we begin, I'd like to share more about the program that allowed us to host this webinar. As I mentioned before, I am a business advisor for the Chamber, and I mainly work under the Cook County Small Business Source Program, which was designed to support, grow, and elevate small businesses in the Cook County area by providing no-cost business advising, resources, and access to events. For more information, please feel free to contact me or wait until the end to get our contact information. And now to give the presentation back to today's speakers, Mandy Riles and Chuck Martin.
Thank you, Kayla. My name is Chuck Martin. I'm a tax partner with Wipfli. We have offices throughout the country. Joining me today is Mandy Riles. She won't be presenting. She's going to be assisting me along the way as needed. I've been doing this for about 40 years, so working with small businesses to larger enterprises and individuals of all different means and wealth over that time frame, and here to offer some advice and some instruction on some of the things that you need to be aware of when looking at taxes. When I was chatting with the chamber when we were putting this program together, they highlighted for me that most of the people in this presentation are going to be newer small business owners, could be anywhere from 1 to 20 full-time equivalents, just learning how to navigate the tax, landmines, I guess is probably the way I'll put it. So why don't we dive in with the major types of enterprises that most of you will have already probably set up, or if you're just getting started, things to consider. Most individuals who are just starting, maybe if they want to call it a side gig of some sort or their new enterprise, they're going to set up themselves up as a sole proprietorship. It means you don't have any legal filings with the Secretary of State or anybody. You basically just start your business. You could call it anything, ABC Enterprises. You could just set up a bank account and some business cards, and you're off to the races and you're ready to go. But what does that really mean from an income tax standpoint? From the IRS's perspective, they consider you self-employed. So you're not working for somebody who's going to give you a paycheck, take out taxes, give you a W-2 at the end of the year. You're going to be responsible for recording your information, managing your income, paying your taxes, and if you hire employees, dealing with payroll-related matters. And I'll touch on these things as we go on. So for a sole proprietorship, that's the easiest way to get things going. And it's a nice way to start if you really aren't sure where you're going to go in the future. And you're going to add another schedule to your tax return. If you try to do this on your own, that's fine. There's software packages to help you if you want to do it, or online systems. I'm not going to endorse any of them, but I'll tell you there's some out there like H&R Block and others. So, they'll help you through the process. But basically what happens is, most of us are going to report on a cash basis. That is, if we get cash in the door or a check or a credit card payment from our customer, that's income. And then the easiest way to think about expenses is this. If you would not have incurred that expense except for the business enterprise you set up and are running actively, it's a deduction likely. It's just where it needs to go and how much of it is deductible. Obvious things is if you're selling a product, whatever you're buying the product for that you've then sold will be an expense. But understand if you're selling products, but you buy it and you haven't sold it yet, that's inventory. So there's a balancing act there you have to be aware of. But expenses like maybe insurance, car expenses, if you have payroll, whoever you're hiring, those types of expenses have to be tracked. And a schedule goes on your tax return to reflect all this information. That's kind of the short answer. There's a lot more to it, but that's the short answer. The next type of enterprise that most of us see in this business is if two people or more get together to run an enterprise. So let's say you and your best friend decide that you're going to start an enterprise and you're each going to own half of it and you're going to devote your best efforts to it and you're going to be putting in money and you're going to hopefully make a profit. Generally speaking, that is a partnership under the tax rules, because you're going to be partners. If you don't set it up as any other type of entity, the two of you just agree to get together and start working. Same types of concepts. You're going to record your income, manage your expenses. If you have others working for you, you'll have payroll matters, which we'll dive more into as time goes on in this conversation. But you're going to basically have to file a separate tax return. So this one now is because the IRS considers it a separate business independent of the two partners. A partnership income tax return has to be filed, both at the federal, state, and depending on where you are in the country, sometimes there's local levels. What happens from that? You basically get a tax form out of that partnership tax return that you then pull into your individual income tax return to report your share of any income or loss, whatever it may be, and then you'll finish off your personal return. That is a very common type of entity. For the ones who are looking a little bit beyond that, you're generally going to be looking at a limited liability company, which offers maybe a little more legal protection. I'm not an attorney, but I'll tell you the benefit of working with a lot of small businesses over the years is sometimes it's beneficial if you can to try and have some sort of barrier between third parties and yourself in the event of some sort of claim. Some claims you can't avoid, but others you can mitigate. And this is where you really want to have good legal counsel when you're ready to set up a business that has maybe something related to food or anything that might have chemicals or something that, individuals could be hurt and harmed, and you want to make sure you're doing everything in the right way. An LLC operates, or limited liability company, as it's really called, operates the same way as a partnership. So for income tax purposes, your partners or members technically under that rule, and you still file a separate income tax return. You get a tax form from that entity to include into your personal tax return, and you just move forward. Are there advantages of being an LLC versus a individual or partnership? There are some, probably beyond the scope of this, because it gets into the nuance of what you're doing and how you're doing it, and more importantly, how profitable you expect to be. But I'll talk a little bit more about that as we get into this. The last type of entity that we really see a lot of, probably less today than we did 10 or 20 years ago, but we're still seeing these subchapter S corporations. A subchapter S corporation is actually a legal entity under the law in state of Illinois, especially, and it files its own tax return. It is truly a corporation. You become an employee of that corporation, and you would get a paycheck to the extent you were going to take out any money for regular compensation purposes. And that entity would file a tax return. You would still share in the profits if there's any left and report it on your individual income tax returns, just like an LLC or as a partnership. So it sounds kind of funny that you'd have three types of entities that have similar types of filings. They all fall under a category or umbrella called pass-through entities. So what happens is all the information is reported at the entity level, and it passes through to the owners in proportion to their ownership. So why do people use one entity versus another? Well, an S corporation, we used to see very much 10, 20 years ago, a little bit less today, is if you expect to make a significant profit. That is, let's say you're going to be making more than whatever the Social Security max is for a year. So let's say it's going to be more than $150,000. Why does that matter? Well, for an S corporation, you have to take out what's called reasonable compensation. So let's say we're taking out whatever the Social Security max is. Anything you get above and beyond that would be taxable, but it wouldn't be subject necessarily to Social Security or Medicare tax. So there can be some income tax savings if you use the S corporation as you move up in the profitability of the enterprise. In a sole proprietorship, partnership, or limited liability company, those caps aren't there. So if you are very, very profitable, you're going to pay not only income tax, but you're going to pay Social Security tax to the cap, and you're going to pay Medicare tax on everything above that to the extent you are actively involved in the business. And how I'm giving this presentation today is I'm assuming that most of us are actively involved in our businesses. If you're a passive investor, there are different sets of rules a little bit beyond the scope of this presentation today. So those are the real small things you have to worry about, in terms of you have to do these separate filings. But there's a lot of things that you want to consider when you're looking at deductions. Most of us, obvious things, the business expenses, like if I have to have workers' comp insurance or business liability insurance, I have to buy product, I have to buy, print business cards, I have to pay for advertising, all those things are pretty obvious. Then you get into questions like, well, I need health insurance. Well, can I deduct that? Typically, the answer is yes. There's some caps. You have to actually make a profit. If you're a sole proprietor or a partner in a partnership or a member in an LLC, there are some rules that you have to jump through to make sure you can deduct it. And it usually, is dictated by having a profit. In an S corporation, you can have health insurance. That's not really tied to making a profit or not. So that's sometimes a little bit of a differentiator. And, typically when you're dealing with health insurance in this day and age with, say, the marketplace, you're dealing with high deductible plans. So in addition to that, you might have an opportunity, if you can afford it, cash flow wise, to have a health savings account. Health savings accounts have different caps for individuals and families, but it's an opportunity to leverage your tax deductions for payment of, health insurance, things that are not covered, I should say, under health insurance, deductibles, co-pays, maybe glasses, dental work, things like that, up to whatever the caps are. Since I'm self-employed technically as a partner in a partnership, I've been funding an HSA for many, many years and using it to pay for all of my uncovered medical, dental, and eye type items. In addition to those types of benefits, if you're profitable and again, you have cash flow and you can afford it, you're going to want to look to start setting up something for your future retirement. If you're really thinking ahead, is that you want to consider how you're going to retire someday if you're only paying for yourself and you're not working for a major employer who's providing you some sort of retirement benefit, or at least an ability to do a 401k to start funding for your retirement. There are lots of different pension plans, a little bit beyond the scope to just describe all of them in any detail, but they're very simple to the complex. So from the simple side, there are self-employed pension plans. There are defined benefit, defined contribution plans. If you're a single person in your own enterprise, there's solo 401ks. If you're going to have multiple employees, you could set up a 401k plan, excuse me. You could set up additional benefits that would maybe help you attract employees and allow for you to fund for your benefits for your retirement. The thing you have to remember about retirement planning, and I'm not an investment advisor, but I'm just sharing my experience, is the sooner you start and the more disciplined you are, the more successful you're going to be over time. We always have the issue of what are we going to spend our money on? And that's the common question that always comes up is I have to do this, I have to do that. If I'm going to expand the business, I need more money for advertising, I need to hire staff. At the same time, you have to look inward for yourself and your benefit for your family and say, if I'm not putting something aside on an annual basis, I'm going to get to the end of my current career, whatever it is, in 20, 30, 40 years, whatever it's going to be, and I'm going to be looking at myself and say, I have nothing. And that's going to be an issue. So you really do want to contemplate that as you're moving along so that you don't have a huge surprise when you get to the end. The benefit for these health savings accounts and retirement plans is, even though 23 is passed, we actually have up until the filing date of the tax return to fund it for 23. So if you look into this and say, you know what, I do have an actual extra 6,000 or 5,000 or 10,000, what could I do with that money that would help benefit me for 2023, even though 2023 is closed? Well, health savings account funding and IRA and pension plans can be funded all the way up to the filing of the tax returns for April 15th typically, but some have later dates if you make an extension. An extension is sometimes, if you've never done one, is just an opportunity to file the paperwork after the initial deadline of April 15th, all the way up to October 15th if it's an individual return. It's usually September 15th if it's one of the other types of entities, a partnership or S corporation, if you file an extension. Sometimes we need them because we may be really busy and can't get to all the information we need to have it done on a timely basis, but it's still timely as long as you file an extension. What you don't get with an extension is time to pay the tax. You still have to pay your taxes. And this is where I'm going to dive a little bit into some nuance. Once we're self-employed or a partner in a partnership or a member in an LLC or a shareholder in a S corporation, those are the terms, and we're getting allocated profit of some sort that we are going to get taxed on, we hope, or at least we should structure those entities that they're giving us some cash flow to pay taxes. And taxes really depend on how much you're making per year. So, it may not be more than 20% if you're not making a lot of money, but it could be as high as 50% if you're making more and more money as time goes on. You have to make these payments to the IRS and to the states on a somewhat quarterly basis. It's not exactly every 3 months. For individuals, it's April 15th, June 15th, September 15th, and January 15th of the following year. They're loosely called quarterly estimated tax payments. Think of it as a plan to pay as you go. So based on whatever you're making after your expenses, calculating some sort of tax rate against that, and then sending in an estimate, that's why they call it an estimate, of what you think your tax liability will be. And when you go to do your tax return at the end of the year, after the close of the year, I should say, you take and calculate your actual liability, net all your estimated tax payments against what your real liability is, and then you have them even up. If you still owe more money, you have to pay it by April 15th. If you overpaid, You can take a refund or you can apply that to the next year. Most people, if they're continuing the enterprise, will just roll it over into the next year. Reason for that is as we move into the next year and we're filing our taxes, typically in March and April, that April 15th deadline comes around for the next year's estimated tax payment very quickly. So you want to take that into consideration and not forget it. Partnerships generally don't have any federal estimated tax payments. Very few types of taxes would be paid at a partnership or a limited liability company or an S corporation. That's not to say there's none. There's just very few that apply and generally don't apply in most cases at the federal or IRS level. But there are state considerations. What we want to do is look at the state considerations on a state-by-state basis and say, what do we have to file? What are the tax regimes? Are there opportunities to save taxes by making certain elections? And this is where sometimes working with a knowledgeable tax preparer or talking to somebody in one of these types of programs in the Chambers of Commerce can be a great resource to tell you, hey, there are certain things you can take and make at the state level that'll help save you taxes overall. But generally speaking, in Illinois, as an example, if there's a net profit in the partnership, LLC, or S corporation area, there is this 1.5%. They call it a replacement tax. I'll call it an income tax. So that tax is due. It's not significant, but there is one that's out there. In addition to that, depending on how profitable you are, there are other elections to potentially save you additional federal tax dollars. But that, again, is beyond the scope of this conversation for today. It gets into a lot more nuance depending on how much money you're making. Other tax planning tips. The thing to really consider is the long term. When you're looking at making an election or a decision about taking a tax deduction or how things going to impact you, let's say you buy a piece of equipment that you need in your operation. Should you deduct it all today? Well, generally saying that probably makes a lot of sense, but let's say you're in a zero tax bracket and there really wouldn't be any benefit. Sometimes it's more beneficial to depreciate it over time and take it, especially if you're in your first year and you're not making a lot of money and you expect to make more money in your second, third, and fourth years. So again, having a conversation with somebody on terms of your expectations of how you're going to make money over your first few years and what are going to be some of your one-time expenses that you're going to incur, and see where the benefit is to take it to get the best bang for your buck. So those are some of the conversations, again, if you want to talk through it with somebody who's been there before and say, hey, what have you done? How do you maximize the benefits for this? And kind of role play it out a little bit in terms of what your expectations are for year 1, year 2, year 3, if you can get into those types of issues. The next subject I want to talk about is probably a more interesting one than most people like, and that is payroll for employees. This is a slightly different nuance for some of us who've never had employees before and we've always worked for somebody. But what happens is you've gotten to a stage now where you need to bring somebody on, okay? So you bring on somebody who's working, in this industry, let's say, or a friend of yours who's going to help you out, and they're going to be your employee. So essentially what you have to do is you have to act like an employer, and that is you have to figure out a paycheck. You got to take their hourly rate. And by the way, the hourly rate is subject to a lot of federal and state and city rules on minimum wage, the age of the individual, what they're doing, so on and so forth. But the point is you look at their hourly rate times their hours. If they worked more than 40 hours in a week, you got to pay time and a half. So you start getting into all these fun things, and then you have to start doing tax deductions. You got to help them understand what their federal tax withholding is, their state withholding, their Social Security, their Medicare, so on and so forth. And then all of that has to be remitted to various agencies for the federal and state governments on their own timelines. So what we usually recommend is that nobody try to do that on their own. I don't even do it for anybody. I hire a payroll service. The primary payroll services that are out there that I've worked with for many years are ADP and Paychex. I'm not endorsing either one. I'm just saying who I know and who I've seen a lot of times. There are other third parties that do this, but you want to outsource that particular issue. The reason being is the penalties are very severe if you do anything wrong, and you need somebody who's going to help do that for you the correct way. So there's a balancing act here too. You don't want to hire somebody too soon, but once you start getting to the point where you're not getting everything done you need to get done as the business owner, and you've got to bring somebody on, really seriously consider getting one of these payroll services. Let them help you navigate that whole area. Their cost is inexpensive compared to any penalties that you could be subject to. And by the way, if the business does not work out for any reason, that doesn't relieve you from paying the taxes. There's personal liability to the business owner to pay those taxes, and you really have to make sure those are paid timely and first before almost any other vendor. Otherwise, the state and the federal government will come after you individually. That's just, the way the world works nowadays. They call them trust fund taxes for a reason, because they're not your money once you've deducted them from the paycheck. They're really the government's money, and you're holding them in trust for them so that the employee gets credit when they go to do their tax returns. Okay. So back to paying taxes for a moment. I was saying that you have this somewhat quarterly regime for individuals, and for the pass-through owners of the partnerships and LLCs, and for the business entities for like S corporations. You have to also remember if there is something that's due by that entity itself, typically at a state level, now they typically do file quarterly. They're going to file March, June, September, and December. Why do we have inconsistent dates? I don't know the history behind that. I just, know it exists and we have to deal with it. So again, it's one of those things where you just got to be careful. I want to talk about some of the other types of tax deductions people forget, though. Very common things. It's almost like everyday things that we use and just forget. But business owners should, keep track of these things and use it as to their benefit. Our cell phones. How many of us don't have a cell phone anymore? Everybody I know has a cell phone. How much of that is being used for business purposes? We really should deal with that and take some sort of benefit for that on our tax return. Home internet, that could be another one. Our cars, there's two methods for taking car deductions. That is, you can have mileage, which is, the IRS sets a new mileage amount every year. It's a number of cents per mile. You just track your business miles. And then people ask, well, how do you do that? The IRS rule really is they want you to keep a log. I tell people keep a calendar, keep anything that shows your appointments, where you went. If you went to Staples to get office supplies, or you went to the post office to mail out your invoices to your customers, or whatever you did, keep track of all this, especially, the benefit is pretty significant. If you're using a mileage method, you can't double dip and then count all of your gas, oil, insurance, and the rest of that. It's one or the other. So please understand that. So those are just some of the things. And then the other one is, a lot of us, when we're starting out, work from our homes. We don't work necessarily from a location that we're renting until we really have gotten up to some sort of critical mass. So from that perspective, what we want to have people do is understand that there is an office and home deduction still. And for the sole proprietors especially, you have an option of using a number of square feet in the house times a rate the IRS sets per year. It's kind of called a simplified method, but it's a benefit. And you don't want to lose that either just because you didn't know it existed. There are a couple of hoops to jump through. One is it has to be exclusively used for your business. The example I give is, I have a 4-bedroom house. I have one room in my house that is my office. Nothing else is in here. Nobody else is allowed to do anything in here. There's no television, to watch. All it is my computers, my internet, phone, and other setups that allow me to do my work on a daily basis if I'm not in my regular office in Lincolnshire, Illinois. But I'm here 90% of the time. So if you're really working out of your house, as a lot of us do when we get started, think of that as an additional benefit. But please, if you can, try to make sure it's exclusively used for the business, for the room or space that you're identifying. You can't use your kitchen table. You can't use your dining room unless it's only used for that purpose, so on and so forth. So I just want people to know there are some nuances to that. Let's see here. What else do we want to talk about? So we talked about sole props, LLCs, S corps. There is one other type of entity we didn't touch on. So that is a traditional C corporation. You don't hear it a lot, but there is a benefit to it. For a C corporation to actively be used, it's a company that is going to need to reinvest its profits into the future. And let's say it's creating working capital from its current profits, and it needs to maintain the most of those profits to grow over time. And a C Corp is good from the perspective of it has a flat tax rate of 21% federally. And that can be less expensive than an individual who is, say, fairly profitable, and the top tax rate could go to 37% for them. So 37 versus 21 is a pretty attractive rate differential. And in the right situation, having a traditional C Corp matters. And it can help create, that working capital in a more tax efficient way to help you get to the next level. And then, there are other things to consider in the future in terms of what's your exit strategy. If you know kind of how you're going to set up your business for the long haul, where you're going to start, where your expectations for income is, and where you think you want to get out, you can model this with somebody who's been through it to say, okay, which tax structure makes the most sense in your particular situation? Would a C Corp today work? Would an LLC work today? Would a sole prop work today? And then maybe we make it an LLC. So you see a lot of times people starting with the very simplistic sole proprietorship because they don't know how successful they're going to be. And then as time goes on, they say, okay, now I'm doing well enough. What other structure should I consider? Or if they're working with an advisor who brings it up and says, hey, now's the time for you to flip the switch to this type of entity and why. That also is a partnership of when you're working with somebody who does this every day, they can help advise you along the way. So we see a lot of times where somebody will be an LLC or a sole proprietorship for a while, and then maybe make an be a corporation and then make an S Corp election. You can mix and match different things. There is one little drawback I do want to mention with the LLC is this. In a lot of cases, I see couples put together an LLC to operate their new enterprise, and they are both owners, when really only one is working in it, and the other one really isn't. They may have a job, or they do something else that's not related. So when you have multiple owners of a limited liability company, we're obligated to file this partnership tax return. And I usually try to avoid that because it's an expense. And you would say, well, why is an accountant trying to tell you not to incur an expense if you're paying the accountant the fees to do it? Because we don't like doing it unnecessarily. What we try to advise you is if when you have two people really actively involved in the business and you want to set up a partnership, an LLC or an S Corp, whatever, and you're going to file a separate tax return, that makes sense. But when it's a couple and only one is really doing it, and they're just saying for convenience, we're just going to put both names on it, I tell them, stop, please don't. Let the person who's really going to run the enterprise be the only owner of the LLC because of this rule. The rule says if you only have a single owner of an LLC, you don't have to file another tax return. You can consider it just like a sole proprietorship, file it as part of your individual tax return. A lot easier, no expense of a second tax return. If you really do have, like I said, two members and you have to do a partnership, that's fine. But again, look at what you're really trying to do and analyze the cost benefit sometimes of setting both names into something if there's only one person operating it. And I know I talked a little fast, but that's probably most of my question, I should say, the points I wanted to get across, and then I wanted to move to questions which might allow me to move on to some other things I have to talk about. So Kayla, I don't know where the chat is on this one. Here's the chat. I don't know if there's anything in there, but if people have any questions, you should feel free to throw something in the chat. If it's something we can't answer today, we will share our email address at the end of the presentation and you can follow up with us. Or if it's something really unique, we'll let you know and that you need to talk to somebody about it in more specifics. So I've opened up the chat, and Kayla, I've opened up, I hope you're opening it up too. If there's something in there, let's make sure I'm seeing it.
Yep, I'm checking it as well. Just got someone saying thanks, Chuck.
Oh, we appreciate the opportunity. I will say it's the small business person that creates all the new employment. Typically, it's not the big enterprises. And if we've all been hearing that they're all scaling back and you see a lot of layoffs occurring, it's the small businesses are the ones that are creating the jobs and creating, everything for the economy. So kudos to all of you who are willing to do it and willing to take the risk. And we all hope that you get a substantial reward for it. Somebody made a comment here. There's a new rule that you have to report under FinCEN, which is the Financial Crimes Network, your beneficial ownership. So there's this beneficial ownership information form that has to be filed now with the Financial Crimes Network or FinCEN. We don't do that because we think it's the practice of law, but I appreciate the person who has put the comment up there. You should work with somebody who understands those rules. And typically, if you're working with an entity that has a filing requirement, and that's usually an attorney, they will take care of that for you. The rule just started. If you began your new organization in 2024, you have to register in a very short timeline. I think it's 30 days. But if you've been around a while, you've got till next year to get it registered. The registration seems to be pretty easy. I went through one with a client of mine last week at a bank, and basically it was just who are the legal owners and what percentage ownership did they have and who had operational control of the business enterprise. And this was an LLC I was chatting with the banker on, and they filed it on the person's behalf. So I agree. Please be aware of that. So here's an interesting question, and I love this one always, is how much you want to budget for accounting services in your first year, average hourly rates? They're all over the board, so what I try to tell people is if you can find, when you're just starting out, you want to find somebody local who can help you. Most don't want to do accounting, let's say. They want you to track your revenue expenses, come to talk to them at the, however you want to, when, let's say, you're setting up, and then when you need to do your tax returns. Tax return fees average anywhere from $500 for an individual return up to $5,000 in this market, regardless of your size, because it goes from smaller firms to bigger firm fees. Hourly rates might be $50 to $100 an hour for a smaller firm to $500 to $1,000 an hour for a bigger firm. So most people don't necessarily need the bigger firms until they get to a little bit more of a critical mass, or they're in a specialty industry where they're doing a lot of research and development, and they want to talk to somebody who understands the credits, okay? And there's very specific things. So some other questions that are coming up. Do you need to have a business tax identification number from the Internal Revenue Service? Yes, that's for basically every business. You want typically a business name of some sort. And even if you're a sole proprietorship, so let's say it's ABC Enterprises may already be taken in the Chappelle market, but come up with some unique name, Dewey, Cheatham and Howe Accountants. How about that one? I like it. We'll set it up and put a tax identification number application to the IRS. We'll get an ID number. We have a name. We'll go to the bank. We'll set up a bank account under the sole proprietorship. If it's an LLC, I have to go to the Illinois Secretary of State and have that set up there. Most people, I recommend use a law firm or use LegalZoom or something that online. There is some nuance of how you set it up. Most people don't understand the differences in terms of the options. So again, I really do suggest having legal advice to make sure you're doing it correctly. If you are going to have a fellow person be an owner with you, or a member or partner or shareholder, I would strongly recommend legal advice to create what's called an operating agreement or shareholder agreement, so that you are not only talking about how you're going to operate the business today, but if for some reason the business has to break up, how you're going to deal with that business divorce. So it's very important that you try to do things a little bit more than just a handshake and go from there. Now, for another question, that's how do you file as an LLC? Goes back to the point of, if I'm the only owner of the LLC, I don't have to file separate tax returns. I just include Schedule C as a sole proprietorship with my individual federal 1040, and then that'll roll over to the state automatically. So again, it's very simplified. If I do have multiple members in the LLC, I have to file a U.S. partnership return. That's a Form 1065 as opposed to a 1040. And that 1065 will kick out a tax form to the members or shareholders, which is a K1, and that K1 then will go into that 1040 of that individual owner. Trademarks I'm not going to get into because I don't know anything about trademark law. But putting it under an LLC, yeah, you want to, again, talk to an attorney. You may end up having to talk to two attorneys, one to help create the LLC, and then another one who specializes in trademark law. I don't usually see a lot of them doing both at the same time. It's usually one or the other. Think about like medical specialties. Not too many people do surgery on the head and the foot. They pick one or the other. So that would be my example. More questions are welcome. Kayla, did I miss anything?
I believe there's one more. It states, "This is my first year to file taxes under an LLC. What are the documents I will need to have ready?"
That's what I
Not
just
sure.
talked about.
Oh, okay.
All right, and then the new one is, do I still pay taxes if I don't make a profit? You don't pay taxes if you don't make a profit. That's the fair thing, let's say, of being in business. What it can do, though, is help offset other income. So let's say, I'll give you an example. I'm married. If my wife works for a company, gets a W-2 and makes $25,000, and I lose money in my LLC my first year or 2 years in business, because I'm still getting it off the ground, let's say I've lost $10,000, that $10,000 loss can help offset that $25,000 of income my wife makes, and then we only pay tax on the net, or 15,000. And that might be low enough that we don't pay tax at all, because we have a child and we may get some, child tax credits, things like that. So you do definitely want to file. You definitely want to put everything together and see what benefits you get, even if you lose money. The one thing you want to understand is, in some cases, even if I'm single and I lose money, there could be this loss. I get to carry it forward and use it against the next year's taxes. So it's generally not lost. Its benefit may not be huge, but it might be something. So definitely have to file, and there's definitely benefits to consider even if you don't make a profit. And thank you, Kayla. Kayla
And
will
then,
definitely hook you guys up with somebody on incorporating. That's part of what they do.
mhm. And then, yes, we can share the recording with everyone. And if there's any further questions,
If you send them to Kayla, or Kayla, if you want to show Mandy's email address in there, we'll be happy to look at questions that come in. If it's something we can't deal with, then we can send it to Kayla to maybe hook you up with a local resource. We'd be happy to try and do that for you guys.
yeah.
As you can tell from how fast some of this goes, there's a lot of nuance to the specifics. So it's very helpful to talk to somebody about what your plans are, what type of business you're talking about, what are some of your concerns or thoughts, whether you're going to do this alone or with a partner, and then they can ask some questions and help you understand the pros and cons of the different options. I personally like the KISS method. Keep it simple.
Okay, well, if we don't have any further questions, thank you, Chuck, for that wonderful insight, and everyone who asked questions.
We
See one
appreciate the
more check.
opportunity to be here, and we hope that you all have very successful enterprises. And if there is something that we can offer you or help you with, don't hesitate to reach out to Kayla or to my colleague Mandy, and we'll see what we can do. You get to do the next one, Kayla.
Yep. And then our contact information as well for my wonderful team. Feel free to scan the code to see the different programs that we have in-house, or to call the office at 312-425-9500, where you will get a hold of our sweet admin assistant, Loli, who can assist you in scheduling a one-on-one advising session with someone from our team. Okay. Thank you everyone who joined us, and also want to share our event that's coming up. If you guys are interested, I can drop the link in the chat as well. Thank you guys.
Thank you, everyone.